You stare at the final line of your pay stub. You earn $180,000 a year working remotely. It is a quiet victory until you look closer. Nearly $15,000 of your labor vanishes annually to state income tax. The frustration is visceral. You feel the structural drag on your wealth. You decide it is time to relocate. You want to capture that lost margin. You pack your bags for a zero-income tax state, calculating the exact day this raise will make you wealthy. You are about to discover a brutal mathematical reality. States do not run on magic. The taxman always gets paid. He just changes his name. On the first path, you chase the headline. You relocate to the famous zero-tax utopia of the Sun Belt. You anticipate an instant mathematical victory. The 0% tax rate is seductive. It feels like a loophole you finally learned how to exploit. On the second path, you ignore the headlines. You run a total cost of ownership simulation. You choose a boring state in the middle of the country. You accept a moderate 4.5% income tax. In exchange, you get highly regulated, stable infrastructure costs. The first path feels brilliant. The second path feels mundane. But wealth is rarely built on headlines. On the first path, you feel invincible. You take your projected $15,000 in tax savings and apply it to your housing budget. You purchase a sprawling $650,000 home in a booming Sunbelt suburb. You believe you have outsmarted the system. You confuse a structural shift in tax liability with an actual increase in purchasing power. You lock your capital into a massive, illiquid asset. The house is beautiful. The weather is perfect. The trap is officially set. On the first path, year 2 begins with an envelope in the mail. It is your homeowner's insurance renewal. The climate reality of 2026 has forced statewide carrier exoduses. Your premium skyrockets from $2,500 to $9,500. There is no negotiation. There is no alternative. On the second path, a similar envelope arrives in your boring, low-risk state. Your premium renews at a flat $1,400. The promised income tax savings on the first path is instantly vaporized. It is consumed by a single private sector expense. You escape the state government, only to be captured by the insurance carrier. On the first path, the county assessor comes collecting. Municipalities without an income tax still have to pave roads and fund schools. They rely on heavy property taxes to survive. Your booming property value is reassessed. You are hit with a 2.5% property tax rate. Your annual bill is $16,250. On the second path, property taxes are capped at 1.1%. Your bill is $4,900. On the first path, the realization sets in. You simply traded a transparent, predictable tax for a hidden, escalating tax. And this new tax is permanently attached to the roof over your head. For both paths, the economy turns. A market correction lowers your remote income by 40%. On the second path, your moderate income tax automatically drops in exact proportion to your pay cut. It acts as a natural financial shock absorber. The state takes less because you earn less. On the first path, the danger of your zero-tax utopia is exposed. Your combined $25,000 property tax and insurance burden remains permanently fixed. The county and the insurance carrier do not care that your income dropped. You replaced a variable liability with a fixed structural liability. The walls begin to close in. On the first path, you discover the final layer of the illusion. Because there is no income tax, every municipal service must be aggressively monetized at the point of use. You encounter massive vehicle registration fees. You drive on privatized toll roads that drain your account daily. You pay high local sales taxes on every item you consume. You are constantly nickel and dimed in a supposedly tax-free haven. The psychological exhaustion compounds. You spend your days managing microtransactions just to exist in your own city. The zero-tax state is a luxury subscription, and the monthly fee is rising. 5 years later, the divergence is complete. On the first path, you have zero net margin invested. Every dollar of your supposed tax savings was consumed by carriers, assessors, and tolls. You look wealthy on paper, but you are entirely captive to your fixed costs. On the second path, your boring, moderate tax structure preserved a true, frictionless surplus. You kept $1,500 a month in pure margin. That surplus was quietly automated into broad market index funds. It compounded in the background. You built a massive liquid balance sheet. You did not chase the illusion of zero taxes. You chose the quiet mathematics of total cost of ownership, and that made you truly free.